Welcome to you all to my YouTube channel. So, with this COVID-19 situation, the prevailing condition of our country, so almost all the A-level students are waiting at their homes without studying anything. So, I thought of doing a helping hand project to them by conducting several lessons in YouTube. So you can refer to my lessons via YouTube and get something to your knowledge. So I hope to provide a clear understanding about several accounting questions, accounting lessons like cash flow statements and management accounting and companies accounts. So those are the critical and complex areas. So I hope to provide you a better understanding via YouTube for you to enhance your A-level knowledge while waiting at your house. So by this time, when it comes to February and March, most of the schools might have completed companies account. So I assume so. So our next lesson is to study about the preparation of cash flow statements. So for that, you have to have a clear understanding regarding the company's accounts. So the standard which covers the cash flow statements is LKS 7. So before moving on to LKS 7, we have to have a clear understanding what is a cash flow statement and what's the purpose of preparing cash flow statements, because normally in your second A-level accounting paper, for the second paper, they allocate 10 marks for the cash flow statements, and for the MCQ paper as well, there are questions up to 4 to 6 marks. So the standard which covers the preparation of cash flow statements is LKS 7. So before moving on to preparation of cash flows, so we have to understand what is a cash flow statement. So it's just a summary of your cash book. Simply a summary of your cash book which is presented in more nice and more presentable manner. The purpose of preparation of cash flow statements is very important. So the most prominent one is to identify the cash inflows and cash outflows throughout the period. So let's take an example. Let's say the companies are acquiring PP now. So by analyzing the cash flow statements, the management can understand their utilization of money, their utilization of cash for acquiring PPE is high. So next year they are going to reduce the level of acquisitions of PPE. So those decisions can be taken by analyzing the cash flow statements. And second one, it's a legal requirement. So when it comes to a set of financial statements, there are 5 components: income statement, balance sheet, cash flow statement, changes in equity, and other explanatory notes. So it's mandatory to prepare the cash flow statement. In addition to that, it provides a clear view regarding the management strategy. So why the management is using cash, why in which strategies they are, in which ways they are utilizing the company's cash, and in which way they are receiving cash towards the company. So those things we can easily identify by analyzing the cash flow statement. So let's have a small mind map regarding the cash flow statements. We can prepare our financial statements using 2 methods. That's the accrual basis and cash basis. So statement of comprehensive income, statement of financial position, and the changes in equity statements are prepared in accordance with the accrual basis, and the cash flow statement should be prepared based on the cash basis. So when it comes to the cash flow statement, it can be prepared using 2 methods. That's the direct method or the indirect method. So when it comes to your examination, sometimes they clearly mention that you have to use this method, but sometimes they don't mention. You have to understand, or you have to identify in which method you have to prepare your cash flow statements using the given information. So when preparing cash flow statements, we assume that our company can utilize money and receive money in 3 ways. that is the operating activities, investing activities and financing activities. So either the direct method or the indirect method, those three activities are same, and the balance, net balances of those three activities are also same. So either the method you use to prepare your cash flow statements, or direct method, maybe direct method or maybe indirect method. Financing activities are same for both methods. Investing activities are same for both methods. But only the operating activities are different to each method. So, but the balances are same. So you have to clearly identify which transactions to be recorded under direct method and which transactions to be recorded under indirect method. So when it comes to the operating activities, so simply operating activities are the day-to-day transactions of the company. So whatever the transaction that the company is performing for their main business purpose are coming under operating activities. So when it comes to the direct method, under operating activities there are only 5 transactions. So those are basic cash receipts and basic cash outflows. So under the direct method, in operating activities, there are 5 transactions. So that is cash sales. So that means you receive cash at the time of delivering of goods, at the time of performing the sale transaction. And cash received from debtors. So normally you may sell on credit. So you are receiving money in a future date. So that receipt is coming under this category. And cash purchases, the other side. So you pay money at the time of purchasing the goods. And cash paid to suppliers. So you pay to your suppliers, which was purchased under credit basis. And cash paid in operations. So that is coming under normal company cash payments like administration expenses and selling and distribution expenses. So it includes salary payments, advertising payments, so those things. So under the indirect method, the operating activities are little bit complex. So it's little bit tricky. So you have to start up the question, you have to start up the indirect method operating activities from profit before tax, right? So under profit before tax, so you calculated the profit before tax based on which basis? So that's the accrual basis. So there may be some non-cash transactions like depreciation and doubtful expenses. So those expenses has been deducted when arriving at the profit before tax. But actually you have paid money. No, you haven't paid money. So you are preparing the cash flow statement. So you have to come up with the cash balance at the end of the financial year. So when arriving at the profit before tax, you might have deducted those non-cash transactions. So that's incorrect. Maybe correct. It's correct when calculating the profit before tax, but when you are arriving to the cash balance using profit before tax, that deduction is not allowable. So you have to add them back. So in addition to that, there may be some transactions like disposal gain. So those gains have been added when arriving at the profit before tax. But those gains are not really cash gains. So the disposal gain is simply the difference between carrying amount and the disposal proceed. So that gains are not earned by way of just money. So that has to be deducted because it added to the income statement when arriving at the profit before tax. In addition to that, we have to work out very important thing, changes in working capital. discuss the changes in working capital by taking an example. So simply, working capital is current assets and current liabilities. So as I said earlier, either the direct method or the indirect method, investing activities and financing activities are same. So examiner may be asked for you to prepare the cash flow statement based on the indirect method or the direct method. So the investing activities may not going to change for both methods. So investing activities, what are those investing activities? So that's the money you received from investing activities, like disposal of non-current assets, and cash outflows like acquisition of non-current assets. Further, it includes the income received from investments and interest income and dividend received income. So dividend received, so those things are there. And when it comes to the financing activities, the cash flows which make changes in equity capital and debt capital of the company. So it includes acquisition of capital, acquisition of loans, those things. So most of the cases, the dividend part is tested. So dividend received, if the examiner says dividend received, so that's coming under which method, which category? So that's coming under investing activities, because you have invested somewhere in order to receive dividend. So that's coming under investing activities. So let's take dividend payments. So dividend payments are made to whom? To the existing shareholders. Why you are paying dividends? Just because of you have issued your equity capital. So acquisition of equity capital and the changes in equity capital is coming under which activity? Financing activity, right? So dividends payment should be categorized under financing activities, whereas dividend receipt should be categorized under investing activities. I will attach a material with this video for possible activities coming under each 3 activities, right? So you can refer that for your further studies. So now I'm going to present you a small mind map based on your balance sheet. So with the position of the transaction in your balance sheet, you can be easily identify in which category it belongs to in your cash flow statement, right? So let's draft a small balance sheet and I will show you how that relates with the cash flow statement. So under non-current assets, it includes property, plant and equipment and fixed deposits and other investments. So changes in those transactions should be recorded under investing activities, right? And the changes in equity and non-current liabilities should be recorded under financing activities. And changes in current liability and current assets should be recorded under operating activities, right? So now you can easily check where that transaction is recorded in your balance sheet. That balance is recorded in your balance sheet, and through that you can easily identify to which category in your cash flow statement it belongs to. Okay, so I hope now you are having a small understanding regarding the preparation of cash flow statements. So the theory behind the preparation of cash flow statements. So now please let me explain you a past paper question with its calculation. So I hope that it will be more easy for you to understand how to face with a examination, how to face with an examination question. So this is 2017 question number 6 part B. So before moving on to the question, before moving on to your working paper, you have to clearly read and understand your question. It's really important. So you have to plan how to do your question, how to prepare your answer. So as you study for business studies, planning is completing 50% of your task. So you have to plan how to prepare your question before moving on to the calculation. So just take 2-3 minutes and read and understand your question. So it will be more easy for you to sum up with the answer. So I will read the question for you. The following information relates to Ravindu PLC. An extract of the statement of profit and loss and other comprehensive income for the year ending 31st March 2017. Gross profit is given, expenses, depreciation, finance expenses, profit before tax is given, income tax, profit for the year. So the profit for the year in the sense that's the profit after tax is also given. The summarized statement of financial position. So normally for you to prepare the cash flow statement, income statement and the balance sheets are, both the statements are given. So the summarized statement of financial position as at 31st March 2017 and as at 31st March 2016. So to 31st March 2016 is your opening balance, 31st March 2017 should be your closing figure. So under description, property non-current assets, property, plant and equipment at cost and accumulated depreciation, and under current assets, inventory, trade receivable, cash and cash equivalents, those things are given. And under equity, stated capital, that is the ordinary shares and retained earnings, and non-current liability, bank loan, and current liability, trade payables, accrued finance expenses and accrued income tax. So that's your balance sheet. And there are 3 additional information are also given. An item of property, plant and equipment purchased for 9 million was sold for cash on 31st March 2017. So it has been sold on 31st March 2017. That means at the end of the financial year. The accumulated depreciation of this asset on this date was 4,100. Dividends of 900 have been paid during the year. So what is that? Dividend paid. So the question is given, but they haven't mentioned in which method you have to follow. I mean the direct method or the indirect method. So please keep in your mind, based on the given information, you have to decide which method you have to follow, right? So in this question, based on the information, the profit before tax is also given. For this question, you have to follow the indirect method because the profit before tax is given, right? So this should be your format of your cash flow statement. So Ravindu PLC statement of cash flows for the period ended 31st March 2017. That statement is really important, right? And cash flows from operating activities. So normally when it comes to the indirect method, operating activities component, normally a half a page is enough. And cash flows from investing activities and cash flows from financing activities. And you have to start up your question from here. This is the last one, is cash and cash equivalents as at 31st March 2017. So that is the year-end cash balance. And cash and cash equivalents as at 1st April 2016. That's your cash book balance at the opening date. And changes in cash and cash equivalents, that means the change in your cash position from opening date to closing date. So it may be a positive one or it may be a negative one. So what does that cash and cash equivalent means? So cash, it's really simple. So that's the cash book balance or the cash in hand. Cash and cash equivalents, what do you mean by cash equivalents? So that includes whatever the other similar components like cash, like bank overdraft. So bank overdraft is also a cash balance, but it's a negative balance, right? So bank overdraft is a liability, that thing you know. So it should be deducted from your bank balance. So in a balance sheet, there may be cash book balance as well as the bank overdraft balance. So you have to net those two and put the net figure here, right? So opening balance are also the same. So according to this question, in your current assets you can see inventory, trade receivables, cash and cash equivalents. So the opening balance, that means as at 31st March 2016, the opening cash book balance is 1,900. And at the same time, you have to check whether there's any corresponding liability under current liabilities. So trade payables, accrued finance expense, accrued income tax. so no bank overdraft. So the opening balance is 1900 and the closing balance is 2000, and so the opening balance is 1900 and the closing balance is 2000. Changes in cash equivalents. So that's really simple. Opening 1900, closing 2000. That means there's a change of 100. So before moving on to the question, you have already received your answer. So whatever the net balances of these three transactions, these three activities should be equal with this 100. And then the second step is to put this is indirect method. So you have to put the profit before tax. I take it as PBT, profit before tax. So your profit before tax is given at the in the paper. So that is 3000. Right. And then let's move on to adjustments. An item of property, plant and equipment purchased for 9 million was sold for cash on 31st March 2017. The accumulated depreciation of this asset on this date was 4100. So this is regarding PPE. So normally for cash flow statements, PPE part is a little bit complex. So that thing you have to clearly understand because it's including the depreciation as well. So let's mark whatever the balances should be recognized under PPE. So when it comes to the income statement, gross profit, gain on sale of property, plant and equipment, so that's related with PPE. Just mark it, just circle it. And then operating expenses, no. And depreciation, okay. So depreciation is also related with the PPE. Finance expenses, profit before tax, income tax, profit for the year. So that's all for the income statement. And when it comes to the balance sheet, property, plant and equipment balance at cost and accumulated depreciation. So those line items should be reconciled for PPE. As I said earlier, you are preparing the cash flow statement based on the indirect method. So you are starting up with your question with profit before tax. So when arriving at the profit before tax, you have already deducted your depreciation and you have already added your gain on sale of property, plant and equipment, right? So depreciation, is it in cash outflow? No, right? It's just a book entry. So when arriving at the PBT, you have already deducted your depreciation, but it's not a cash transaction. It's a non-cash item. So when arriving at the cash book balance, it should not have been deducted. So you have to add it back, right? So as per this question, the depreciation balance can be extracted from the income statement. That is 1200. And the gain on sale of PPE, so it has been added to your income statement when arriving at the profit before tax. So do you think that the disposal gain is a cash receipt? No, it's just the difference between carrying amount of your asset and the disposal proceed. So it should not be added here, it should be deducted because it has been already added, therefore we deduct that. So as per the question, the disposal gain is 700. Don't forget to put brackets here. In your first adjustment, you saw that they mentioned that they have disposed an asset at the end of the financial year. So it's better to draft a T account for the movement of your balance. So because of I don't have enough space to put the cash flow statement as well as the workings, I will clear this and you continue with your cash flow statement in your working paper. So I draft two accounts for PPE, cost and accumulated depreciation. And let's put opening and closing balances here. So because the balance sheet is given, you can put those balances. So under PPE at cost, the opening balance is 30,000. I just put 30 here. and the closing balance is 37. So PP is an asset, so the balance in PPE should be a debit balance. So opening 30 and closing 37. So now we have to reconcile how this 30 has become 37 at the end of the financial year. That's all. Accumulated depreciation, opening balance is 14.9. It's a credit balance, and closing balance 12. An item of property, plant and equipment purchased for 9 million was sold for cash on 31st March 2017. Right? So you have disposed an asset. So when disposing the asset, what would happen? PP cost account should be credited. So the cost is given. That's 9 million. So I just put 9 here. So it should be credited. Right, that's all regarding PPE cost. So opening 30 and disposed 9 and closing balance is 37. Let's balance the account. So the total is 46 and the credit side also 46, debit side also 46, but there's a difference of 16. Right? So what is this? So we assume that the company might have purchased the assets by paying cash. In which category this 16 belongs to? So this belongs to investing activity. So because this is a PP item, whatever the movement should be goes to investing activity. So now I don't have the cash flow statement to write down this. So now you can continue. Under investing activities, just put cash paid in acquiring PPE assets or acquisition of PPE. Correct that you receive a PPE item, but you are losing your cash. So you have to remove that from your cash balance. That means it's a negative figure under your investing activities. So now I draft a disposal account. So they disposed an asset which was purchased. When did they sell that asset? On 31st March 2017. How the double entry should goes? PP cost account credit, disposal account debit. So I put cost 9. Under additional information, the accumulated depreciation for the disposing asset is also given. How the double entry should goes? Accumulated depreciation. Now we are removing the asset, so accumulated depreciation is having a credit balance. At the time of removing balance, it should be debited. So accumulated depreciation account debit, disposal account credit. So this is the accumulated depreciation. I put disposal account here, and it should be credited to the disposal account. Right. So now this accumulated depreciation includes the total depreciation up to the disposing date. Okay, that's fine then. It has been fully depreciated up to the disposing date. When it comes to a disposal, there are 5 steps. First one is to remove the cost. Yes, we already did that. And second one is to remove the accumulated depreciation up to the financial year starting date. Okay. And third step is to remove the current year depreciation. So in this question, this 4.1 includes the total depreciation up to the disposing date. So no need of putting that step 2 and step 3 separately. So this balance include the balances which should be comes under step 2 and step 3 as well. So now this asset is at the carrying amount. And what is the fourth step? Is to record the disposal proceed. So cash account debit, this account credit. But we don't know the disposal proceed. It's not given. And what's the fifth step? To record the disposal gain and loss. Okay, so in this question under income statement, it's given gain on sale of property, plant and equipment, that's 700, that means 0.7. So it's a gain. So then income statement credit, this account should be debited. Okay, so that's all about the disposal account. So now you can balance and easily find the balance should come here. That means you have received 5,600 money by disposing the asset. So it's a cash inflow towards the company even though you lose the asset. So it's also a which activity? Investing activities, because it's related with the PPE. So under investing activities you have to clearly mention cash receipt from disposal of PPE. So that's a positive balance because you receive money now. Okay, so that's all about PPE. So it's really simple. So can you remember earlier I mentioned that you have to have a clear understanding in company's account when preparing the cash flow statements. So when preparing the company's account, you put a note for property, plant and equipment, right? So in that note you mention opening balance, additions, disposals, revaluation and the closing balance for each property, plant and equipment item. So that's all. Only that 5 items are included in that account. So if you have that understanding in your mind, you can find those 5 balances from the given information and put here. Okay, so the second adjustment is dividends of 900,000 have been paid during the year. So dividends paid, in which activity it belongs to? So dividend paid, so you are going to pay, your company is going to pay. Why you are paying? Because investors have invested money in your company, maybe ordinary shareholders, so you are going to pay. So those ordinary shareholders money are recorded under equity. You are paying the return on behalf made by ordinary shareholders, so it's coming under financing activity. So it's you are losing money because you are paying dividends now, so it should be a negative balance under financing activity. You just continue with your answer sheet, just put dividends paid minus 900,000, right? You can reconcile the dividend payment like this. Comparing the company's account, from where did you remove dividends? From where you deducted dividends? So that's from the retained earnings, right? So let's take a T account for retained earnings. You can get the opening balance from your balance sheet. For retained earnings, opening balance is 1,800. It's equity, so it should be a credit balance. Closing balance is 2,100. Right. So please recall your mind when preparing the company's account. What types of transactions you recorded under retained earnings? The major thing is profit for the year. We can extract it from your income statement. That's 1,200. And now they mention the company has paid dividend of 900,000. So you are paying now. So your balance sheet goes down. That means debit. So now let's check whether the account is getting tallied. If it is getting tallied, no issue. Yes, 3,000. Here also 3,000. So we recorded this, right? So now the account is getting tallied. There's no issue. So let's say dividend payment of 900,000 has not been mentioned in your additional information. So but you have to put a working for retained earnings like this and check whether the account is getting balanced or not. I mean, if the account is not getting balanced, indirectly you have to find whether there is any dividend payment, right? So this is really important. And the last adjustment is cash received from the share issue during the year was 8 million. So you have received cash by issuing shares. So in which category it belongs to? So you are issuing your equity. You are raising your equity capital. So it should be coming under finance activity. Now we are getting cash. Now we are receiving cash. So it should be a positive balance. So under financing activities, put cash received from share issues. It's 8 million. 8 million. And then you can reconcile it as well. So just take a T account for ordinary shares. Just get the opening balance from the balance sheet. The opening balance of ordinary shares is 10,000 and the closing balance is 18,000. Have issued shares for 8 million. So we recorded that. So the account is getting balanced. No issue, right? So all the adjustments are over. So now you have to check all the transactions have been recorded in your cash flow statement. So let's take from the beginning. Gross profit we don't record. Gain on sale of body plant and equipment we deducted, and operating expenses that's paid in cash, so it has been deducted when arriving at the PBT. So that's okay, that's fine. And depreciation we added back, and finance expenses. Okay. So normally finance expenses includes the interest expenses, those things. So it should be recorded under operating activities. So when preparing the income statement, we prepare on which basis? So that's based on the accrual basis. So even though you have not paid or paid, we record the whatever the amount that you have to pay. So this 1,300 is the amount that you have to pay. So it has been, we don't know whether it has been paid or not. It has been deducted here. So we add it back again. So we have to add it back again and find out how much you have actually paid. Now we have to find out the correct amount that you have paid during the year, paid in cash. So for that you have to check whether there's any overpayment or accrued payment in your balance sheet regarding with the finance cost. So if you check your balance sheet, you can you can see there's an accrued finance expense balance, right? So let's draft a T account for that thing. So the opening balance is, it's a liability, so the opening balance is 3,000 and closing balance is 4,000. And the finance cost expense is 1,300. So it has been debited to the income statement, so it should be credited to the finance cost account. So that's all. Now you can balance it. So there's a difference of 300 in the debit side. So that should be the cash payment. So cash account credit, finance cost account debit. So this is the cash payment. There's some exemption for the finance cost, so it should be recorded under operating activities, right? So it should be recorded here. So it has been paid, therefore it should be a negative figure. And next one, profit before tax, we have already taken that. And income tax. So income tax also we are paying in cash, but when it comes to the income statement, we don't record the amount that you paid, whatever the amount that you have to pay. Like finance cost, do we need to add it back? So there's an income tax expense of 1,800. Do we need to add it back? No, right? Why? We started the question with PBT, that's the profit before tax. So that means the income tax expense has not been deducted. So therefore, no need of adding it back again, right? So to find out that, you have to take a T account. You have to draft a T account. I will draft my T account here. Income tax. Just check for any opening balances in your balance sheet. Accrued income tax opening balance is 1,200 and closing balance is 900. So from your income statement, you can see that there's an income tax expense of 1,800. So income statement debit income tax expense account credit 1800. So now you can balance that. So 3000 minus 900, 2100. So income tax account debit, cash account credit. So that means you have paid 2100 as your income tax during the year. So I should record here. Profit for the year we have already taken to the retained earnings balance, and now the income statement is over. Now when it comes to the balance sheet, property, plant and equipment we did, accumulated depreciation we did in the sense we reconciled, and current assets. So under current assets, cash and cash equivalents are there. We started the question with the cash and cash equivalents, so that means we have already taken that as well. And inventory and trade receivables are still remaining. So what are those things? Inventory and trade receivables are working capital. So since we are using the indirect method, we have to put the working capital, we have to put changes in working capital under operating activities. What is your first working capital? That's inventory. So inventory, if you see the opening balance, there's a 3000 balance of inventory, and when it comes to the year end, it's just 2000. So what has happened? Balance of 1000 has been sold to someone and we have received money from them, right? So the decreasing inventory should be a positive balance, because we can assume that there's a cash receipts towards the company. So we write decrease in inventory and a plus balance of 1000. And the second working capital, that's trade receivables. So at the start of the financial year, it's 8000, and at the end, it's 9000. So the trade receivable balance has been increased. So that means we can assume that you have given some amount of money. That means 1000, the difference is 1000. So you can assume that you have given 1000 rupees to someone else. So it's receivable yet. So it's you have given, in the sense it's a cash outflow from your company. So increase in trade receivables should be a negative balance. So inventory we are done, trade receivables we are done, cash and cash equivalents we are done, and when it comes to equity, stated capital, so it also we did, and retained earnings we reconciled, and non-current liability, so bank loan opening balance is 8000 and the closing balance is 7000. So why the bank loan balance has been decreased? The bank loan balance is getting decreased just because you settled that. So that means during the year you have settled 1000 amount of money from your bank loan balance. So bank loan is coming under which category? So that's coming under finance activity, because bank loan is a debt balance. So in my earlier mind map I mentioned non-current liabilities should be coming under financing activities. So it should be a negative transaction for the financing activity. So you have to mention like bank loan repayment minus 1000, right? And then current liability, so trade payables. So as I mentioned earlier, current assets and current liabilities, both things are working capital. So we are done with the current assets. Now current liabilities, trade payables. So just reconcile the balance. Opening balance 4000, closing balance 6000. That means when it comes to the financial year end, you have decreased your trade payable balances. So that means you have to pay more. Why you have to pay more? We can assume that you have received money from them. That's why you are payable now. Okay. So payables should be a positive one, because we assume that you have received money during the year. Next one, accrued finance expenses we did, accrued income tax we did. So that's all about the cash flow statement. Now you can get the balance of cash flows from operating activities to here. Balance this, you can see there's a net cash flows from operating activities. It should be, the word should be net cash flows from operating activities is 4,500. So that's the total of the above transactions, right? So you have to do the same for the investing activities as well. Investing activities is not really complex like this. There were only 2 or 3 transactions as far as I could remember. And for the financing activities as also the same. You have to put net cash flow from investing activities and net cash flows from financing activities. And now in the second column you can see there are only 3 balances. So there's the net cash flows from operating activities and net cash flows from investing activities and net cash flows from financing activities. So if you sum up that 3 balances, you can see it is getting tallied with the change in cash and cash equivalents during the year. So according to this question, it is 100, right? So sum of these 3 balances should be equal to 100. So now your cash flow statement is over. So that's all about the 2017 past paper. So nearly it will take around 10 to 15 minutes for you to complete this question. So please keep in your mind, you have to clearly mention your workings. So because the examiners are allowing marks for your workings. As this thing, your workings are really important. So keep in your mind when preparing the cash flow statement, clearly mention your workings as well. So that's all about the 2017 past paper. So let's meet with another past paper question in another day. So if you have any further clarifications to be made, I will mention my telephone number, so you can WhatsApp me or call me for any clarifications.